friends, I'm Vivek Segal and welcome back on my YouTube channel. A few days back, Finance Minister presented budget in the Parliament. Although budget gives details of government's expenditure and revenue, there is a section in the budget which interests all of us. It is a section which pertains to personal taxation. Despite the fact that income tax affects all of us, most of us believe that income tax laws in India are too complicated and the income tax can only be calculated by a CA. In today's video, I'll try to explain the basics of income tax so that you can yourself easily calculate the tax. So let us see how income tax is computed.
Before we get into the concept of income tax, let us first understand what is assessment year. In India, we have a concept of financial year. A financial year starts from 1st of April till 31st of March next year. All income earned during this period from all the sources is clubbed together to form gross total income. For example, let us assume the financial year 22-23. The financial year in which the person earns is called the previous year. But the income tax department does not assess your income in the same year. The income is assessed in the next financial year, which in this case is 23-24. This is called the assessment year, the year in which your income is actually assessed to tax. So, assessment year is not the year in which you earn, it is the following year in which you earn. A lot of people get confused between assessment year and previous year, so this clarity is important before we move forward. A word of caution here. Even though you are assessed to tax in the next year, it does not mean that you can avoid paying tax in the year you earn. In India, we have a concept of tax deduction at source. That is, we end up paying tax at the point of earning. Hence, tax is deducted before the salary is paid or interest income is earned. So, the first step in computation of income tax is to calculate your total earnings for the financial year. I'll explain later in the video how to calculate total income. Your total earnings during the financial year from all sources is called gross total income. However, you do not pay tax on your total earnings as some income are exempt from tax. For example, you may have an agricultural income which is exempt from tax in India. All such earnings which are exempt from tax are called exemptions and they must be removed from gross total income to get taxable income. However, even the entire taxable income is not taxed. The government allows you certain deductions which must be subtracted from the taxable income to get net taxable income. This is what is finally assessed to tax. Even here, you do not end up paying tax on your entire net taxable income. The government gives you certain rebates. Rebates are like certain concessions on tax rates. As of now, there are two ways to calculate the tax on net taxable income: old regime and new tax regime. An assessee has a choice to choose either of the two tax slabs, wherever his liability is lower. Towards the end of this video, we'll see the pros and cons of both the tax regimes. So let us see in detail each step on computation of tax. Let us start with the first step, computation of gross total income. As discussed earlier, a person can earn income from various sources. But for income tax purpose, all income earned from different sources is classified under 5 different heads. These are income from salary. If you are a salaried person, this will be your main source of income. Income from business or profession. If you are self employed or run a business, your primary income will fall under this category. Income from house property. If you have a property where you receive rent, your rental income will fall under this head. However, this head refers only to the rental income from property. If you sell this property, the gains arising will not be taxed under this head, but rather under the next head, income from capital gains. So, if you have a capital asset like property, shares, mutual fund, etc., and if you sell them, the gains are taxed under this head. And lastly, any other source of income which cannot fall under any of the four heads above, falls under this category. Income from other sources. This head will include income like interest earned on your bank deposits, dividend from shares, to earnings from lottery or gambling. All these earnings will fall under this category, income from other sources. A person may earn income from any one of more of the above sources. For example, a salaried person having rental income and dividend will earn under three heads. So all the income from all the sources during the financial year is added to form gross total income.
So guys, now that we have calculated gross total income by adding income under all the five heads, one thing to be noted is this entire gross total income is not assessed to tax. Income tax, as we had mentioned earlier, provides for certain exemptions and deductions. Section 10 of the Income Tax Act provides for certain exemptions. These exemptions are basically the income which is exempted from tax. These exemptions are never a part of taxable income. So they must be removed from gross total income to arrive at taxable income. What are these exemptions? Let us look at them.
Exemptions. As mentioned earlier, exemptions are the earnings which are either fully or partially exempt from tax. So they must be removed from gross total income to arrive at the taxable income. Let us look at some of the exemptions under Section 10 of the Income Tax Act. Agriculture income is exempt from tax in India. So is the members' share in HUF. As HUF pays its tax as an entity, the members' share becomes tax exempt in their hands. Similarly, the partner's share in the profit of the partnership firm is exempt in the hands of the partners. Gratuity, pension, provident fund are also fully or partially exempt from tax. Schemes like Sukanya Samriddhi Yojana and LIC have their returns marked as tax free. HRA is an important allowance as a part of salary for most employees. It is an important allowance and can drastically reduce your taxable income. I'll take it up in detail on how to compute it and use it for tax planning in my exemptions video. LTA, children's allowance, and hostel allowance are also important allowances which are available under this section.
So guys, after these exemptions are removed from gross total income, we get taxable income. But you don't pay tax on this taxable income also. Income tax laws provide you with certain deductions which must be removed from the taxable income to arrive at net taxable income. What are these deductions? Let us have a look at them also.
So let us look at some of the important deductions which are available to the assessees. These deductions are basically classified under three categories. One which are available to everybody, all the assessees, some specifically to salaried employees, and third to those availing house property. One thing to be noted is most of these deductions are not available under the new tax regime. Apart from standard deduction, all these deductions have been done away under the new regime. But for those who are following the old tax regime, let us look at these deductions. So the most popular among all the deductions remains the one under section 80C, wherein you invest up to 1.5 lakh into either one of these schemes: life insurance premium, provident fund, equity linked savings scheme, national savings certificate, and so on. Here the maximum deduction available is 1.5 lakh. I'll be taking over deductions as a separate video because it requires a detailed explanation. But for a quick run through, these are the major deductions which are available under section 80. 80C 1.5 lakh, 80CCD National Pension Scheme 50,000, 80D 1 lakh, and so on. As I mentioned earlier, there are two deductions which are available if you purchase a house property: 24A and 24B. 24B specifically refers to when you take a loan on your housing property and pay interest thereon. Standard deduction of 50,000 is the only deduction which is available now even in the new tax regime.
So after you remove these deductions also from your taxable income, you get the net taxable income. It is this net taxable income on which you have to pay income tax. So how do you calculate income tax on the net taxable income? Let us have a look at it.
So now that you have calculated net taxable income, it is now time to pay the tax. For paying the tax, the government has given two choices. You can pay tax as per the old tax regime or as per the new tax regime. In the old tax regime, you have the advantages of all the deductions which we just saw, whereas in the new tax regime, no deductions are available apart from the standard deduction. Let us look at the rates in the old tax regime as well as the new tax regime. I'll be making a separate video on the details of the old and new tax regime, the difference between the two, and a calculator to calculate the actual tax if you follow the old regime or the new regime. In the old tax, the slabs are 5%, 20%, and 30%, but the income till 5 lakhs is exempt from tax. In the new tax regime, the income till 7 lakhs is exempt from tax, and the revised slabs are for 3 to 6 lakhs 5%, 6 to 9 lakh 10%, 9 to 12 lakh 15%, 20%, and 30%, so on. Please look at my video on the tax rates for better understanding of this topic.
So friends, to sum up, your income from various sources is clubbed into 5 different categories. The income under these 5 heads is added to get gross total income. But there are certain incomes which are exempt from tax. These exemptions are removed from gross total income to get taxable income. From the taxable income, we remove certain deductions which are available under the Income Tax Act to get the net taxable income. It is on this net taxable income that the income tax is applicable.
As of today,
There are 2 tax regimes which are prevalent, the old regime and the new regime. An SSE has a choice to choose either of the 2 regimes and pay tax accordingly.
so guys, I hope you
Enjoyed watching this video. Do remember to like the video and subscribe to my channel. Thank you.